All right, let's dive right into this explainer where we are going to put M&T Bank through the ultimate financial gauntlet. Today, we're stepping into the shoes of an expert investment analyst, and we're going to take a hard, objective look at this regional banking powerhouse. We'll be running its latest data through the rigorous frameworks of some absolute legends, Warren Buffett, Peter Lynch, and Benjamin Graham. Plus, we're going to crunch the hard math using traditional valuation models just to see exactly what the numbers are telling us.
Here is our game plan. We'll start with a quick baseline snapshot of M&T Bank, then systematically walk through those three distinct guru philosophies. After that, we'll apply our cash flow and dividend models, and finally bring it all together for a definitive blended valuation verdict. Let's get to it.
Section 1. M&T Bank Company Snapshot. Establishing the baseline.
So right now, M&T Bank is trading at $248.04 a share. And honestly, this price tag is backed by some serious fundamental momentum. They just reported a record second quarter GAAP earnings per share of $5.32. To put that into perspective, that is the highest quarterly diluted earnings per share in M&T's entire history. Absolutely massive.
And when we look under the hood, their current financial health is brilliant. We're looking at a price-to-earnings ratio of roughly 13.1, which is based on a trailing 12-month EPS of $18.94. Their tangible book value is sitting pretty at a healthy $115.96 per share. Profitability? It's robust. They've got a 12.3% return on common equity, and they're maintaining a rock-solid CET1 regulatory capital ratio of 10.33%. That gives them a really thick safety cushion. Throw in an excellent net interest margin of 3.70%, and you basically have the picture of a highly profitable, well-capitalized bank. Section 2. Moving on to the Warren Buffett lens. Economic moats and owner earnings.
Now you know Buffett's framework is famously strict. He's looking for a business with a deeply protective economic moat, highly capable management, consistent high returns on equity, and manageable debt levels. But crucially, and this is the big one, he demands a margin of safety. He wants to buy that business for significantly less than its true intrinsic value.
So, looking at our Buffett checklist, M&T actually passes with flying colors. For an economic moat, they rely on really strong local relationships and sticky deposits. Those generate fees no matter what the interest rate environment is doing. Management is clearly shareholder-friendly. They executed a massive $1.25 billion in share repurchases in the first quarter alone. Earnings are hitting those record highs we talked about. That 12.3% ROCE is fantastic for a regional bank, and their 10.33% CET1 ratio tells us their debt and risk are highly manageable.
But here's the thing, Buffett is a total stickler for price. When evaluating banks, owner earnings can be a bit tricky to define, so we have to make an assumption here and use their strong net income as a proxy. If we project this out and demand a strict 20% margin of safety on a fair earnings multiple, Buffett's likely target buy price sits around $227. So at today's $248, he might really admire the business, but he'd likely sit on his hands and wait for a slightly better pitch.
Okay, Section 3. Let's switch gears to the Peter Lynch lens, growth, price, and the PEG ratio.
Lynch loves to categorize companies, right? And he relies heavily on the PEG ratio. That's price to earnings divided by the earnings growth rate. For Lynch, a PEG ratio of exactly 1.0 means a stock is perfectly, fairly valued. Anything below 1, that's an undervalued bargain. It's his way of ensuring he never overpays for future growth.
Applying Lynch's framework, we'd categorize M&T as a stalwart. It's exactly the kind of large, stable, maybe slightly boring company he loved, offering a steady dividend and moderate growth. We know the PE is 13.1. For growth, we're assuming a pretty conservative 10% forward rate, which is largely based on their impressive 14% net operating income growth back in Q2. Dividing those out gives us a PEG ratio of 1.31. Their balance sheet is strong, and those heavy buybacks we mentioned, that acts as a great proxy for positive insider action.
So the takeaway for a Lynch investor is that this PEG ratio of 1.31 means M&T is reasonably priced for its high quality, but it's definitely not a deep discount bargain. For a stalwart category stock, this triggers a solid hold verdict, or, a buy only on broader market dips when that PEG ratio inches closer to that magical 1.0.
Section 4. The Benjamin Graham lens, the defensive investor checklist.
Benjamin Graham, the godfather of value investing, famously didn't care much for qualitative narratives or grand promises of future growth. He believed in buying hard assets and current earnings for less than they are mathematically worth. He used a specific formula: combining earnings per share and book value per share multiplied by a constant of 22.5. This finds a hard, undeniable mathematical ceiling for what you should pay for a stock.
Now, if you run Graham's defensive investor checklist, M&T is a rare breed that actually clears his extremely rigorous hurdles. They have massive, adequate size with over $213 billion in assets. They boast tremendous earnings stability, a reliable $1.50 quarterly dividend, which comes out to $6 a year, and remarkably moderate multiples. We're talking a PE below 15 and a price to book below 1.5.
Let's see how this builds when we do the math. Plugging M&T's trailing earnings of $18.94 and their common book value per share of roughly $173 into Graham's equation, we get a defensive intrinsic value of $272. So, at today's price of $248, Graham's absolute value method suggests M&T is actually trading at roughly a 9% discount to its hard asset and earnings value.
Section 5. DCF and Additional Models, the Hard Math of Valuation. Let's strip away the philosophy for a second.
A standard discounted cash flow, or DCF model, involves forecasting free cash flows out for 5 years, calculating a terminal value for the company's perpetual growth, and then discounting it all back to today's dollars using a specific weighted average cost of capital.
But there is a vital assumption we have to state here as expert analysts. Because a bank's free cash flows are heavily obscured by regulatory capital and lending requirements, traditional DCFs can sometimes be a bit misleading. Therefore, we also want to lean heavily on the dividend discount model, or DDM. This values the bank based entirely on the hard, tangible cash returned directly to the shareholders via dividends.
Just to be totally transparent with our DCF math, assuming an industry-standard 9% cost of equity, which serves as our discount rate, and a conservative 2% terminal growth rate, our baseline DCF puts M&T's fair value at $228. But, as you can see, variations in the economy can swing this wildly. If we drop the discount rate just 1 point to 8%, suddenly the model says it's worth $278.
Finally, Section 6, Synthesis and Final Verdict, tallying the stress test results.
Okay, the gauntlet is complete, and when we synthesize all of these methods, a really fascinating picture emerges. The strict Buffett margin of safety gives us $227, Graham's asset-heavy formula gives us a high of $272, our mathematical DCF sits at $228, the dividend model is at $212, and comparing historical PE multiples puts it right around $227 again. When we average all these out, we see a strong gravitational pull, establishing a blended fair value around $233 per share.
But listen, numbers never exist in a vacuum. Fundamentally, M&T is performing brilliantly. They're reporting their strongest organic loan growth since 2012, and they're executing a highly successful turnaround in their commercial real estate portfolio, pivoting toward much less cyclical sectors. But as analysts, you have to weigh those strengths against the very real risks highlighted in their filings. Primarily, we're looking at their increased reliance on short-term Federal Home Loan Bank borrowings, which is a much more expensive form of funding, and of course, the intense industry-wide pressure on deposit costs.
So, we leave you with this final thought. M&T Bank is undeniably a high-quality, stalwart operator turning out record earnings. But at $248 today, it is trading slightly above our blended fair value of $233. As an investor, the question really isn't whether M&T is a good bank. It absolutely is. The question is, are you willing to pay a slight premium for that undeniable quality today, or do you have the patience to hold out and wait for the ultimate margin of safety?